Hey, everybody, and welcome back to another episode. I'm your host, Brennan Cobb, and today I've got August Biniaz on the show. He is the co founder and chief investment officer of CPI Capital. He leads their investment strategy, their acquisitions, their asset management. He's got over 15 years real estate experience, and he's been involved in closing more than 225 million in multifamily and BTR assets. He's also the host of the Real Estate Investing Demystified podcast. Go check that out. And he is a recognized voice in commercial real estate. August, welcome to the show.
Brandon, thanks for having me. And to talk about kind of the radio voice, you got the radio voice and you got the TV face. So it's a perfect combo there, my friend.
I've been told I have a face for radio, so I'll take that
Don't
as a
believe that.
compliment. What you just said.
Well, it definitely is.
So everyone wants to know right now. You've got lots of experience in multifamily, and multifamily's kind of been a dog, quite frankly. I know I've seen tons of people on LinkedIn that were touting multifamily. They've changed their tune a lot. Everyone's touting oil and gas and some other alternative assets. Medical office buildings. It seems like everyone has turned their back on multifamily online because there's been a lot of distress since the rate rise in 2022 and everyone who got caught in the bridge debt. I know tons of people who's had to file personal bankruptcies, operators who've gotten out of the business. I know people with multi-$100 million portfolios that literally lost everything in that whole debacle. What are you seeing in the multifamily right now? Because as distressed as it is, I also saw a post from Ken McElroy who he bought 500 million in multifamily, I think, just last year, and he's like, I thought I was going to buy 2 billion, and his post was basically saying, we're not seeing the distress that we thought we were. We expected all this inventory to come to market, and what he was saying was the banks have repossessed the property, and right now they're doing price discovery. It's not going out of, they're just kind of shopping it sort of off market just to see what's what. And so they're in this kind of price discovery phase, but he thinks it's still coming. What's your opinion on this? Where do you think that we're at in this cycle, and what are you seeing?
Yeah, no, definitely. As far as multifamily and the cycle is currently going through, similarly to the whole real estate market, multifamily particularly goes through cycles as well. Those cycles are recession, recovery, expansion, and hypersupply. And currently, multifamily is in the recession phase of the cycle, and that's because of all these different headwinds that are in front of multifamily and making the deals difficult to pencil, making deals difficult to retain, and putting a lot of operators in distress. And those the perfect storm really is about rates. The rates are relatively high, especially looking at where they were over the last decade or so. The multifamily commercial loans are pinged off of the 10-year treasury, and you can see 10-year treasury has definitely risen. You also had issues on the multifamily side with oversupply, hypersupply, as it's also known. So, as you mentioned, post-COVID, the Fed had to decrease rates to save the economy, and that resulted in a lot of acquisition groups and development groups coming and buying a lot of deals. On the development side, that resulted in a lot of supply coming online, and supply has a downward effect on rents and occupancy. So we've seen that difficulty in a lot of growth markets like Phoenix, the Austins, Jacksonville has been a tremendously awful market, unfortunately, and now they lost their football team as well to Orlando. So yeah, it's absolutely the perfect storm. Now, you also discussed distress and Ken McElroy talking about acquiring deals that never came on. I feel CPI is kind of in the same boat. We felt that there was going to be a lot of deals coming online, and that was because you could visually see about the amount of commercial loans coming to maturity. But when that took place, we didn't see the distress coming online, the same number of maturities coming in, because we knew those loans that were borrowed, they were borrowed at a much lower interest rate, and those interest rates were going to be increased, or in a case that their rate cap was going to expire. So the feeling there and the assessment was a lot of deals were going to distress rate was going to have to hit the market. But what ended up happening, a lot of these institutions, financial institutions, unlike what happened in GFC in '08, they actually gave leeway to their borrowers, and this concept of extend and pretend really was taking place. And I talked to some fund managers, investors, and they said that their institutions are like, hey, don't worry about it. We keep your rates where they are. We'll just extend it out for another year. No, we're focused on two different markets: Tampa in Florida and San Antonio and Austin in Texas. And those markets are vastly different. In Tampa, we're not seeing a lot of distress. We are seeing deals coming online. However, a lot of deals are not transacting. Every time a deal comes into our pipeline and we decide to take it, if it matches our buy box and we decide to take a jab at it and send it in an LOI, we always follow through to see what happened to that deal eventually. Did it trade? What did it trade at? What was the price it traded at compared to what we put in? And that data gives us information for us to be more strategic on our next deals and try to be sharpen our pencil on our next deals. And we realize that 80% of deals that come into our buy box that match our criteria, which is more than 100 doors and less than $50 million, don't end up transacting for one way or other. If it might be a owner who just wanted to test the market and go back to their lender and say, hey, look at the price I got. This is what price I got at best and final. We didn't transact, but this is what my property is worth. It's not worth what you're telling us. So they use that as leverage against their lender. There's been cases where the lender forced the borrower to put the property online. But anyhow, now in San Antonio, the market is a lot different. Deals are coming in where they have been foreclosed, or there's been a situation where the borrower has decided to give the keys back to the lender, and the lender is listing the property and trying to get the best price possible. And the lender has to make a decision. If the property was, let's say, the property was purchased for $20 million and there's a $15 million debt on there, but today the property is worth less than $15 million. So all the LP equity is wiped out, the investor is completely out, and now the lender is sitting there with a note that's worth more than what the property is worth today. So they have to make a decision. Should they try to sell, or should they bring in a management team and try to salvage the deal and sell it when the market turns? So it's been a difficult time for multifamily. I do believe because we're in a bust phase of the cycle, we're in the recession phase of the cycle, there will be definitely buying opportunities. But investment groups have to be cautious, and they have to try to be resilient, because I've noticed a lot of larger firms than us that have actually let go of their majority of their team because those costs are erosive to the burn rate of a company, and they cause a company possibly going into distress, because if they're paying all those salaries to team members, which they're just sitting there not doing any deals, would be very difficult. But that's a quick summary, I guess.
So, what do you say to those people? Because I see a lot of posts on social media that people say that like real estate hasn't gone bust yet, right? Like we've got a much bigger contraction coming across the broader real estate market, encompassing a lot of residential. I mean, what are your thoughts around that? Because I'm seeing a lot of people that are posting like the doom and gloom around that. And yet here we are in an environment where even if the war weren't here, we'd be looking at like a lower interest rate environment, which you'd think would be really good for real estate and would help things. But you're starting to see some charts show that like foreclosure rate is going up pretty high.
Yeah, real estate is localized. You did have some markets that ended up having mania, some Florida markets, some Texas markets. Like I mentioned, for example, Austin, the Phoenixes, Scottsdale markets, some markets here in Florida that had difficulties. There's a market here in Fort Myers that close to Naples, where I'm based out of, an hour and a half south of Tampa, that real estate prices have corrected close to 30%. So real estate is localized. On the single family side, it really depends what markets you're in. But overall, when you're looking at commercial real estate on the multifamily side, the demand is really there still, right? You still have U.S. over 340 million population. It is a place that people want to end up being. This is really end of the road. People, the middle class, the upper middle class wants to move out of places like India, like the Middle East, like Africa, and they want to end up, either in Europe, or they want to end up in the U.S. The U.S. is really end of the line. So the brain drain is taking place one-sided. You can see myself, I'm originally from Canada and lived there most of my life, but made the move to the US. So you can see the direction of that brain drain. So I think the fundamentals are always there for demand that exists for US and the growth that is needed for real estate. But real estate is sensitive to interest rates, both on the residential and commercial side. And then when you have oversupply and other concerns, it has a downward effect on prices and other items. As far as sentiment, yeah, what you discussed is really investor sentiment. Investor sentiment is down because the equities markets and other investments have been on a bull run for a long time. You have concerns about a bubble in the AI, and that could have a precipitous effect to the whole economy. You have the Trump administration in office, and they've done some somewhat out of the world stuff, like putting tariffs on rest of the world, which has an inflationary component to it. Same thing with immigration. Trump's administration is really against some levels of, obviously, the focus is illegal immigration, but that has resulted in legal immigration also dropping, which is inflationary as well. So you have a perfect storm. The last thing was missing was a war in the Middle East, and we have the big one: U.S., Israel, and Iran. Which again is inflationary. You have the Strait of Hormuz that's controlled by the Iranians, that 20% of the world's oil passes through, 15% of the world's aluminum passes through, and around 30% of the world's fertilizer passes through, completely shut down. And now Iranians have taken that hostage and are charging fees like the Suez Canal and the Panama Canal charges for every ship to pass through. They haven't done that for the last 100 years. Really, the regime has been in power for 47 years, but they never charge a fee for ships passing through. But now they're charging fees on that, and that, again, that has an
Are
inflationary
you
effect as well.
saying that like the Panama and Suez Canal, like they've been charging fees historically, but now the Strait of Hormuz, Iran wants to charge fees?
And is charging fees, yes. Yeah, exactly.
Okay, so that's a new development. I didn't know that. I hadn't heard of that development. How do you think this whole war with Iran is going to affect the multifamily and build to rent real estate market that you're in?
Yeah, I mean, again, the both multifamily and build to rent, the two markets that we're in, the two business models that we utilize, to asset classes that we're focused on, they are sensitive to interest rates because those are the type of loans that we get. We get commercial loans, and commercial loans are pinged off of the 10-year treasury in most cases. So the 10-year treasury is a organic. Their number is organic. The Fed doesn't set the 10-year treasury. It's an organic price. So if the economy is overall not doing, the global economy overall is not doing well, U.S. economy is not doing well, it's going to affect the 10-year treasury, and those numbers are going to increase like it has over the last few weeks, gone up 40 basis points. A 40 basis point increase, on a, let's say, $20 million deal equates to millions of dollars in price difference as far as what we're able to pay for a deal that, that the 10-year treasury jumps that high. But aside from that is also sentiment. If you got a war happening in the Middle East and the Fed pausing or even increasing the rates, that could result in investors not wanting to invest in these type of alternative private placement type of
Yeah.
investments. They might, want to invest in other types of investments. As much as commercial real estate is a safe haven, but there's other things like gold and silver and other investments that investors might want to invest into and not invest in commercial products. So and at the end of the day, it depends how long does this war last. The Trump's administration, I don't want to get into the politics. We're really real estate guys talking about real estate, but the Trump's plan was that Iran was going to be a Venezuela, where he goes in and takes out the main leader and puts in someone from the same regime, Delcy Rodriguez, and she takes over everything, and she's friendly to the U.S. But the Iranians are a lot different. Iran is a theocracy, is being run by Islamic
Mm.
fundamentalists. Iranian people aren't, but the regime has taken Iran hostage for 47 years. So now that it killed the Ayatollah, his son took over, who's the little Ayatollah is in power now, and everybody in the regime fought in the Iran-Iraq war for 8 years. They're all very extremist type of guys, so they are not budging, and they're ready to be martyrs. So it's very scary times. And Trump kind of goes back and forth as well on what's going on. So it really depends on how prolonged will this war be, or will it be a quick war? And I don't know. It's up in the air to decide on that.
Yeah, it's not good. It's not good. Oil goes up, everything goes up. But what's interesting is you don't seem to have the speculation in the fertilizer market in like fertilizer futures or commodity futures. You have not seen that rise at all. So you think that the people who are in that particular industry that were bracing for impact because the headlines are, oh my God, fertilizer is going to go through the roof and it's going to cause inflation and grocery prices are going up and oil's more expensive. And you got a lot of people who are going to see higher, grocery bills at the store. That seems to be the scary headlines that everybody is saying, but you're not seeing this price discovery in like the agricultural commodities futures, which is really, really interesting there. So, like, what do you think is uh, I get what you're saying with like the inflation and interest rates, right? If inflation comes back and Fed has their higher rates, well, that's bad for multifamily and build to rent industry because it's so dependent on the interest rate environment. Um, but it seems like the Fed is stuck between a rock and a hard place. It's like on one end, you got to lower rates because you got to refinance your debts or your country goes broke, right? We got 7 to 9 trillion dollars worth of debts, depending on who you ask, that have to be rolled this year. But on the other end, if you you're going to get this inflationary environment with oil and everything else, if you don't in the war, and if that happens, they're going to have to end up raising rates, and you're going to bankrupt the country. So it's kind of a rock and a hard place. So, like, what does that mean for multifamily and build to rent real estate? Because it just seems like right now everything is risk off, and it's just going to be harder to attract capital for those areas. So, like, do you think the next move up for multifamily is going to happen when we see all this distress like finally hit the markets? The banks are finally releasing everything that they've been holding on their books and they can't hold off any longer. And there's kind of some new price discovery like in the market, and that's like the new floor. Or, do you see another way out of this like turn that multifamily is going through?
Yeah, I think the distress that exists there is going to eventually come out and is going to, result in a price correction, which has already been taking place. There's been a price correction in Jacksonville, one of the markets we were looking at for a long time. Multifamily prices have corrected between 30 and 40% in Jacksonville. Price correction in Phoenix. Rents have come down in all of those markets as well. And at the end of the day,
Mm-hmm.
it's demand, it's rents, it's interest rates, it's supply. And currently, the perfect storm is that all of those points are in the negative. Negative only not by numbers, but negative as far as whatever the point is. So, yeah, but touching quickly on this point, I mean, the foundational drivers are still there, right? For multifamily, for BTR, for housing in the US, you have over 340 million people. One third of Americans rent. Close to 10%, over 10% of the American population lives in apartment communities, one form or other. Townhouses are part of that as well. BTR is part of that as well. So the demand is there. And you got to also understand that the saving grace could possibly be the new generation. Within that new generation that's coming out, the generation is a very much subscription based generation, right? What generation are you part of yourself?
I'm a millennial. I'm 35.
Millennial, yeah. So the millennial generation, they're a very subscription-based generation. They know exactly how much income they make, what part of that is for entertainment, what part of that is for food, what part of that is for rent. So they actually enjoy being renters much more than their parents' generation or baby boomers' generation, where they love the idea of purchasing a home and what have you. So they're much more transient than their parents as well. They don't stay in the same place for a long time. So they are coming into that rental pool. You also have the baby boomer generation downsizing a lot of times, moving into rental communities. So hopefully that will be the tailwind that multifamily and BTR needs to get them out of this slump. But we are in the recession phase of the cycle. These phases usually last a few years. So I would say we've already been in it for a couple of years, and we got a few more years to go. Maybe at least a year more to go before we're coming back and go into a bull market recovery will be soon after this market. But another point I want to discuss as well when it comes to multifamily in particular, we have a podcast, Real Estate Investing Demystified, and we bring on expert guests like yourself. And at the end of the show, we always ask them a question that if multifamily cycle was a clock and 12 o'clock was top of the market and 6 o'clock was bottom of the market, what time is it today? And we've asked that over the last few months and even the last year. And the consensus is approximately 6 o'clock. So
It's got to
it's either
yeah.
near the bottom, just after the bottom, just going into recovery, I think is right around the bottom or close to it. But that's where we are. We have to just understand that fundamentals will be there for demand. There is oversupply. There are high interest rates. There is low sentiment. As soon as those issues are resolved, the market should turn back around.
So how are you guys sourcing capital? Because I mean, from what I've heard, it has just been, you got to work four times as hard to raise half the amount of money for this asset class. It's been tough. I got my money personally in multiple multifamily syndications, and not a single one is doing so hot, right? And I get it. I understand the limitations and what's happened there. So, how have you guys been able to go out and still continue to find good deals and raise capital? Because it just seems like nothing's penciling, and a big part of private equity firms income is your acquisition fees and like management fees. So how have you guys been able to still navigate this environment and continue to do deals when a lot of people haven't?
Yeah, I'll take the story back a bit, but when I joined a few great partners and co-founded CPI, I come from a development background, a single family spec and custom home development background. I did that for 10 years. And when I joined my partners, I told them right from day one that we have to put an extensive attention on capital raising because as a home builder, I always felt limited to the amount of capital I had access to personally, and I couldn't do larger deals because I didn't understand the process of syndication, funds, the whole idea of real estate private equity. So when we finally started this firm, I said, hey guys, we got to put attention on building a brand around ourselves, building a brand around our company, continuously having investor leads coming in and communicating with our investors. So that was a very important part of the firm, which we have focused on making sure we never turn off the tab when it comes to capital raising and investor relations. Not necessarily raising money, but at least having the conversations and making sure we have leads coming in. So it's been a difficult time for the last few years. Over the last 3 years, we've really closed on two deals, a multifamily deal and a build to rent deal. We are selective, but it's still in those two markets that we are. It's been a hard, very difficult time to close on deals there because there just hasn't been a lot of deals transacting. We put the focus on internally on the company and building the foundation because we didn't get into the business just to do deals and make money. We got into the business to build an institution, to build something great. We followed the Gino Wickman book. And we followed the EOS, Entrepreneurial Operating System, and the book
Yeah,
Traction.
traction or get a grip.
Traction,
Yeah.
yes. Yeah, that's right. And our big hairy audacious goal is to own 30,000 units over the next 10 years. The bottom of the list today on that list owns 27,000 units. So we approximated that in 10 years, if we own 30,000 units, we'll be on the list. We feel that the industry we're in is a great industry when it comes to market share. We made a comparison to other industries. For example, when it comes to online shopping, Amazon has a 40% market share. When it comes to banking, JP Morgan has a 17% market share. When it comes to chips, Nvidia has 60 or 70% market share. When it comes to multifamily and looking at the largest share owners within that industry, the largest one is less than a half a percent. So it's 30 basis points is what the market share for the largest multifamily owner in the US, which is Greystar, has. So it is an industry where it's not dominated by one group or one institution, that there are ways. And you can also see that with, you say you're on social media and LinkedIn, and you can see people on there. You've seen firms over the last few years. Now, they're not doing very good right now, but I've seen firms that come around and There were just a couple of guys who left the firm, and they were able to do billions of dollars in transactions and raise, over $500 million of LP equity. I've seen a chiropractor was able to, raise hundreds of millions of dollars and close on billions of dollars of deals. So it is an industry that gives you that confidence and enthusiasm that it is possible to achieve it as long as you stay focused, as long as you stay resilient. The upside is huge in this space because there's really no ceiling. Like for example,
Mhm.
Blackstone, which is another large owner of real estate and largest private equity firm in the world, they started as a private equity firm doing leverage buyouts and buying companies. At some point, they had a larger allocation to real estate than private equity, and today they have a large allocation to private debt. But real estate is still a huge part of their portfolio. So it just gives you that motivation to want to be resilient. When it comes to us, what also uniquely separates us from other investment firms in the US is that we originally were founded in Canada. So we partner with a lot of Canadian LPs. 70% of our LPs are from Canada, 30% are from the US. We strictly look at US real estate, be it multifamily and BTR, but it is to allow Canadians to have exposure to US commercial real estate, where through a syndication model, there aren't really a lot of firms that offer that model. So that really sets us apart from other groups. But yeah, maybe I'll stop there, see if you have any questions.
No, very, very cool. No, thanks for sharing. That's quite the resume that you guys got. Or coming up here on the end, if people want to learn more about you, learn more about your private equity firm and investment opportunities, where can they go?
Yeah, myself, August Biniaz. I'm very active on LinkedIn. I'm a LinkedIn top voice. So reach out to me on LinkedIn. Tell me you see me on the show. Love to connect and book a call. I also put a lot of great information on there. Our website, cpicapital.com, a lot of great information there. You can check out different tabs that we have on our website, a lot of different great information you can download for underwriting models. And we have a webinar masterclass that we bring on expert guests and have discussions with them. And there's a Q&A section, and that's all recorded on our website, so you can access that.
I love it. Well, thanks for coming on the show. And if you're listening to this and somebody comes to mind that needs to hear what August is saying, share this episode with them, like it. Again, share it with the friends and family, and we'll see you guys next time.